Welcome everyone. Today we'll be talking about macroeconomics in totality. So everyone will understand what is the overall impact of economy and how does it relates to the overall development of the. Whenever I say economy, it might pertain to a country that you can always elongate it to. Development of people, the citizens of the country. How does it impact? What is inflation's the growth rate, and so on and so forth. So let us begin. Macroeconomics is basically the study of structures and performance of national economies. Remember, I have already said whenever I coin the term or I utter the term economies, please put it in the context of a country, right? So, and believe me or not, every country's economies are on a different direction. Certain are we always say there are advanced economies, there are weaker economies, or emerging economies, or the other parlance would be the first world country, the second world country, or the third world country, as the case might be. So yes, the government is basically trying to manipulate the economies in its favor. That means you are looking for a huge kind of projections in terms of growth and development, and that is what macroeconomics is all about. It is the study of structures and performance. Remember, the structure is what are the interventions that we implement, and what happens to it, and how does the country or economic value changes its outlook. So, what determines a long-term economic growth? Remember, it's like akin to your kind of growth or economic. If you earn more and spend less, so you are leading a comfortable life. But if you spend more and earn less, are you living a comfortable life? Probably a life full of debts, and that is not a very conducive one to be leading it. Similarly, in economic growth, also, what determines the long-term economic growth? What causes nations economic activity to fluctuate, and why is that at times the economy, the income and your expenditures, there is a fluctuation and there is no sort of relationship. You just cannot control the expenses despite your limited income, or you just are flummoxed with of plentiful of money, and there are not many avenues for you to spend upon it. So what causes unemployment? We will talk about it. What causes prices to rise? Yes, wherever it is basic equation of demand and supply, wherever the demand is more and supply is less, you tend to see prices go skyrocketing. What does it become to being a part of a global economic system in terms of national economies? And we are talking about the new word is global village, or it in terms we are constraining everything to a centralized economy, and we are getting much more integrated to whatever is happening. Look, whatever is happening in the Ukraine versus Russia war, and you see the inflation has been skyrocketed in almost every economies, every country, be it an advanced one or emerging one, be it the one who has a stake in the war and who doesn't have even the slightest stake in the war. Still, the inflation has been increasing. There is a steady rise in the price of the commodities market, and that is what we are going to do about it. Can government policy be utilized to improve the economic performances? Let us understand long-run economic growth. Rich nations have experienced extended period of rapid economic growth. Poor nations have either experienced them or economic growth were offset by economic decline. So you have period of growth and decline, or probably, if I may say, is it cyclical in nature? No, it is never cyclical in nature. But yes, we see a downtrend and uptrend every now and then. So rich nations have experienced extended period of growth, and you can name a number of nations who have seen affluence across generations, and then there are nations who have been plagued by problems and poverty across generation, and this is what the long run economic growth is all about. It I have already stated, if your income is more and your expenses is less, you are leading a comfortable life. So one way for an economy or a country to go about having a more income is to increase output by increasing whatever availability of optimum utilization of resources is all about. So if it is your population is young, vibrant, increasing, can you make that as an asset? If you have raw materials in terms of minerals, oils, and other products which are akin to your organization or to your country or to your geographic location, can you take advantage of it? Increasing average labor productivity, the amount of output that is being produced per labor is what we are looking forward to, is the increased output things. So rate of growth of output. Now, can we maintain this rate of growth, or if possible, can this rate of growth be improved incrementally over a period of time? What is the rate of growth? Is the output per worker. So number of workers working around in the organizations. When I say organization, please, that might not be the right preference. It might be number of citizens in a country or number of people in a country who are at a productive age, and if their productivity increases even incrementally, overall productivity gallops by leaps and bounds. So that's one of the rate of growth. Then another thing is, what are the and investment strategies that the country is following around it? Is it looking into getting into a debt trap or getting out of the debt trap? How many people are saving around it, putting money into the economy's back? How many of the economies are actually adapting newer technologies? The rate, this is what we need to understand, and the rate of change of other factors in favor of your economy, probably, or against your economy. With the decline of petroleum reserves, many countries would be actually being depleted of their own only economic sources or affluence in times to come. But then there are other economies, other countries wherein there is a huge deposit of lithium, which has been utilized to manufacture lithium batteries for again energy producing things. Their economies are going to be on a higher echelon or on a higher cycle. So everything cannot be of growth oriented, right? Did I say there is an uptrend and there is a downtrend also? So recession is a downward phase of business cycle when probably your expenses is more and your income is less, as the national output is falling or growing very slowly or minimally. So that means what? It means there are hard times for people, a major political concern that comes around it. The government is not able to service its own debts. The government is not able to procure loans for its own people and things like that. And this means there is an upheaval in the general climate of the society. So that is hard time. You will feel that there is no production. You will see there is no requirement for employment. There are no vacancy cropping up. So in that automatically translate that there will be no money in the pockets of the citizen. So unemployment is recessions are usually accompanied by high unemployment. Now that is the number of people who are available for work and are actively seeking it but cannot find jobs. Something which you need to understand. We have this formula for you to understand. Unemployment rate is the people number of people unemployed who are willing to work, who have the requisite skills and knowledge to work, divided by the total number of people in the labor force or the total number of citizens who are in the productive age multiplied by 100 will give you an unemployment rate. At times, if the labor force is more and an unemployment rate is okay, smaller than the denominator, things might be acceptable. But what happens if the numerator is more, the unemployment number of people is more, and the number of labor forces much lesser? Then what will happen? That what you need to understand this thing, and that is what needs to be taken into account. The unemployment rate. Now, unemployment rate can stay high even when the economy is doing well. Now, this is something which people may have a misnomer that unemployment rate are only being plagued into developing economies or emerging economies or economies where they have been plagued with huge population as such. That's not true. Even advanced economies, believe me or not, when I say advanced economies, you name the top 5 countries, top 10 countries of the world, they have in the year 2000, 1998, 2000, 2003, 2004, have seen a huge unemployment rate with nearly approximately 7%. 7% is absolutely a very towering unemployment rate by all standards. right? So unemployment rate happens in either of the countries, and I have already earmarked that economies or countries or economic value goes for an upcycle and a downcycle from time to time, as the case might be. Inflation is when the prices of most goods, services are rising over time. It is inflation. When they are falling, it is deflation. So prices, if they are increasing, so that means there's a demand which outstrips the supply. So probably you will have a premium to the products, premium pricing to the product. So when the prices increases, it's an inflation. When the prices decreases, or should I say supply outstrips the demand, there is a deflation. Inflation rate is a percentage increase on an average level of the price, and that is what we are looking forward to it. Remember, effects of inflation. When inflation rate reaches an extremely high level, extremely, the economy tends to malfunction. Absolutely. It becomes a dysfunctional economy. The purchasing power of the money is crippling. It erodes very quickly, which forces people to spend their money as soon as they receive it, because they know they don't have the money, will not stand the worth of it with the passage of time. It will not any accrued any premium with the passage of time. Why? The banks might not be giving no interest at all. There are no investment opportunities all at all. The prices of the things are going higher every day. So if you purchase an apple for $100, just a proxy situation, tomorrow that apple will be for tomorrow you have to purchase that apple for $200. So why not purchase an apple at $100 as of today, even at a higher rate that I'm talking around it? Day after tomorrow, it can be $250 per apple. So you are making your just cost to make an expenditure or spend the money whenever you get a handful of it. So the international economies, let us understand the economy which has extensive trading and financial relationship with other economies is an open economy. An economy with no relationship is a closed economy, something which we do around it. If it is a well-networked economies with other countries wherein you are a part of a supply chain, or you are exporting or you are importing, so it's almost like a open economy, which is there is a dominoes effect that happens in either of the countries or either of the companies that goes around it. But in case you don't depend on external countries, so it's a completely whatever you produce you consume. You are not dependent anywhere. It becomes a closed economy. You can be insulated by the other impact all the way around it. So international trades and borrowing relations can transmit business cycle from country to country. Yes, if one country has been plagued and that country is in plague for a host of reasons, let's say right now as of today, Ukraine has been in the middle of a war. Now, Ukraine is supposed to be one of the greatest supplier, the biggest supplier of grains around the globe. Just because the war, the Ukraine is unable to supply the same thing, right? And what is happening? It is trickling a price rise in elsewhere economies, elsewhere countries, and they are looking to feel a pinch for it. So yes, international trade borrowing relationship can transmit business cycle from one country to another. Trade imbalances. Trade imbalances are nothing but surplus or deficit. Again, to understand surplus and deficit, please go to that statement of mine or the example that I've given with respect to your income and your expenditure. Which, if income becomes more, what happens? If expenditure becomes more, what happens? So that is what trade surpluses and deficit is all about. It. Remember, trade surplus is when exports exceeds the import. That means you are exporting more money is coming in, and you're taking less, so less outflow of money is going around, so there is more money coming in. But in trade deficit, the other way around, your imports are more, you are absolutely taking more spending more money to get things raw material rather than exporting anything else, because whatever you export, it will give you a little amount of money that comes around it. So overall, this is a trade deficit, as the case might be. Macroeconomic policies, the nation's economic performances depends on natural and human resources, the capital stock, the technology, the economic choices made by the citizens, the macroeconomic policies of the government, thereby that is what is most important as of today. So we need to understand these macroeconomic policies in terms of the natural resources, the money that we are talking about, the technology that we are looking into it, the economic choices made by citizens, and the policies of the government that has been implemented. So let us understand the macroeconomic policies. One is the fiscal policy. Now, what is the fiscal policy? The government ways of working in terms of taxations, in terms of spending. It, is it in building infrastructure? Is it pursuing one of those incentive based to a particular industry that we come around it? Then there is something called monetary policy. The central bank controls the short-term interest rate and the money supply thereby, and that is what we are looking forward to it. Budget deficit, the economy is affected when there's a large budget deficit. The excess of government spending over a tax collection as the case might be, as and when or what is happening around there. The economy is affected. Definitely, yes, we will be going around it. If your budget deficit is there, budget deficit means your expenses is more and your income is less. So you are taking a lot of money from loans as such. So your income is not sufficient to support your expenditure. Budget deficit, the large budget deficit, and I'm giving a very generalized statement, and across the globe it has been seen that both 1980s and 1990s things were on a stringent levels, right? Barring few of the countries, everybody went to an upheaval altogether. There was a huge borrowing from the public, and this might have been diverted fund to other productive use, other uses which was not warranted in the first place. So federal budget deficit might be linked to the declining in the productive growth, as the case might be. This is what we are looking forward to it. That is the budget deficit that comes in. The budget deficit is more expenses, less income. Income by a government is by the way of collection of tax, and if you are collecting tax, or collection of tax is less, that means your productivity is gone down. There is not much of an income that is happening in the corporate body. So it's a vicious circle that comes around it. Now we come into an aggregation. Now, what is happening is often many economics or macroeconomists often ignore the distinction between individual product market and focuses on the national in total. So there might be within an economy, within a country, certain industries might be doing very good, right? And certain industry, or should I say, majority of industry might not be doing very good, or vice versa. Majority of the industries are doing good, and few particular industries are not doing good. So macroeconomics basically ignore this distinction. You need to understand you cannot be having a generalized consumption altogether. The process of summing individual economic variables to obtain a nationwide total is called aggregations, as the case might be. So you need to understand which industry requires support. The government needs to go and circulate or probably implement certain policies which will incentivize in, or should I say, upgrading those industries. So economics, macroeconomists forecasting what they are looking into it based on their analysis, their research, and the data development. Now, macroeconomics would always be looking at a holistic picture, right? And they will not be taken into consideration with individual basis as the microeconomics would be doing around it. So, as a whole, what does it see? What does it feel? And how does it the economics are going to react? So they do their own forecasting basis on the basis of the research they have done and the analysis they have found out of the research part of it. And that is what data development of macroeconomics is all about, it as to what are the required sentiments, what are the intervention that is to be implemented, is warranted at this point of time. So macroeconomics forecasting is a prediction of a future economic trend, has some success in the short term, but in probably in the long term, too many factors are truly highly fluidic in nature and probably too dynamic to ever pinpoint the reasons for what is actually going to happen. Yes, macroeconomic factors can be predicted over a short period of time, let's say 6 months, 1 year, 3 years, but not beyond 3 years at all. You will not be able to know what are the trends that might be overtaking and overlapping, and there it is very difficult to take everything into consideration. Macroeconomic analysis is nothing but understanding the events, the ideas, the data that has been generated both in the public sector and the private sectors, as far as the policy making are concerned. So you need to understand each of the events as to why certain things are working and why certain things are not so. Let us understand the macroeconomic research. Macroeconomic research is trying to understand the structure of the economy in general, on the basis of analysis and forecasting. That is what we are looking for it. So your research will tell it to you based on forecasting techniques and the analysis part as to what is going to happen or what is happening around it. Is it backfiring or is it become more productivity? So economic theories is a set of ideas about economy to be organized in a much more sequential fashion. Economic model is simplified description of the same aspects, or should I say the some aspect of the economy. So that is what modeling would all about it. Theory is all about setting up the ideas, prioritizing them and summarizing them so that one is able to understand and comprehend it in a very logical fashion. On the other hand, the model is a simplified description, nothing else. Simplified description of the economy as the case might be. So developing a testing theory, state the research question, make provincial assumption. Now whenever we talk about testing a theory, we'll have a hypothesis that this is going to go good. And then there is called anti-hypothesis or antithesis that comes around, this is not going to good. One is a positive, the other one is a another thing. So we have hypothesis 1 and the null hypothesis 0. Make provision assumption. So work out the implications of the theory, conduct an empirical analysis. Empirical analysis is all about collecting data points from the right from the sources, analyze those data, try to iron out the noises and come up with a meaningful information, evaluate the result thereby. So data development is macroeconomics, use data to assess state of economy, make forecast, analyze policies, alternative and test theories thereby. And this is what we are looking forward to. This is where it comes across. Providers of data must do about data in science. What kind of data should be collected? For first and foremost, that one needs to be decided upon. Ensure that measures the economic activity correspond to the economic growth as the case might be. This is what we are looking into it, and guaranteeing the confidentiality of the data. Whatever you are collecting, never personalize it and don't try to identify or take advantages of the information. Now, remember, research is only there for an academic purpose. Probably it helps you to augment your future decision and probably to keen and iron out if there are any issues that might creep up. So that is what data development is all about. You should decide upon what kind of data has been going around it. The data you are collecting should be able to be measured and validated, and the confidentiality should be maintained. So what does macroeconomics disagree upon? One is a positive analysis examine the economic consequences of economic policy, but it does not addresses that desirability quotient altogether. Definitely, we are looking at the analysis part of it and coming to the cause and effect relationship. But does it addresses the desirability quotient? What needs to be done? Probably no. It is almost as an after effect that comes around it. A normative analysis tries to determine whether a certain economic policy should be used or not. That is what we are talking about it. A normative analysis might be extrapolating whatever has happened in the past, or probably following up the trend and extrapolating the trend to understand what should have been done and what could have been done or what should be done, as the case might be. So that's the normative analysis. You basically extrapolate the things around it. A positive analysis, on the other hand, is it just studies the economic consequences as on whatever has happened in the economy. The events has been studied and try to finding a reasons around it. Yeah, other thing that the economists can disagree on the normative views is because of the differences in values. Please understand, when I say values, everybody data points are different, so the data collected would be different. Somebody might be, let's say, somebody might look at a chart of the economic growth of a country every quarter wise. Some other economists might be looking at it on an annual wise. Some other would be looking at every 5 years wise. So every time the data point changes from a quarter to an annual to a 5 year basis, you will see different point, different adjectives that needs to be taken into consideration. So there are differences. Economic disagrees on positive issues because of different school of thought, as the case might be, as and when on basis. The classical approach is the invisible hand of economists. General welfare will be maximized, not the distribution of the wealth. If there are free market, individual acts on their best interest. That is what we look forward to. If there are best interest, as the case might be, To maintain market equilibrium, the quantities demanded and supplied are equal. Markets must function without any impediments, without any hurdles. It must be given a free rein to control or to move as it wants to. Wages and prices should be flexible and it should be demand based rather than induced altogether. And that is what the classical approach is all about it. Remember, the quantities of demands and supplies would more or less be same, and the demand will not be induced or not be segregated or subdued in either fashion. This will ensure that the wages and prices are just at the just level. The classical approach, thus, according to the classical approach, the government should have a limited, probably absolutely, and overview of the economy and nothing beyond that. No roles are altogether towards it. Keynes, in way back in 1936, one of the best economies that is still been quoted off late everywhere, assumed that the wages and prices automatically adjust themselves with the requirement of the economy. Absolutely. Thus, a market could be out of equilibrium for a long period of time, and unemployment can persist. This is what we need to understand. Despite a market will not be able to maintain the similarity between wages, prices, can be out of equilibrium, and still there might be unemployment that can persist around it. Why so? Because of the availability of the talent pool that we are talking around it. Therefore, government should take action, proactive actions to remove unemployment. This is what Keynesian would be telling to you. Despite prices and wages are mismatched altogether, despite this thing, there might be a prolonged growth of unsurety of the unemployment. Unemployment needs to be addressed, and it needs to be addressed by the government, where they need to tweak the measures so that the prices and the wages should come to the balances, or else where people would be exploited altogether. The government can purchase goods, one way to induce prices or settle the economy, thus increasing the demand of output and probably reducing unemployment. Newly generated income would be spent, would be raised on employment even further. So whatever income that has been generated by the companies, the corporate bodies would infuse more kind of weightage in putting people, appointing people and filling more vacancies. And that is what the Keynesian approach is all about it. The government can sole be the one of these bodies who can manipulate the economy to induce unemployment or reduce unemployment as the case might be. So let us talk about another concept called stagflation, whereas there's a high unemployment and high inflation. And this was seen in way back in 1970s, and of late it has been seen because of whatever is happening around the globe. It's a modern classical approach which reappeared. Mind you, in this case, there's high unemployment and high inflation. So you don't have money in your pockets, and at the same time, the um, prices of the materials, raw materials, or any retail products is also very beyond your reach. So you don't have money, and prices are high. So it's like a double bonanza, which in a negative connotation. Substantial communication and cross pollination is taking place between the classical and the Keynesian approaches as of now. So you just doesn't work around it, right? So if you have no prices, no money in your pocket, and high inflation, how is it possible? How will you survive? So individual firms, government interact with goods, assets, and labor market. Remember, the this is what we are looking into it. The individuals, the firms, and the government should work in tandem with one another to agree to a certain solution, certain procedures. The macroeconomic analysis is based on an individual behavior, as the case might be. We need to understand the Keynesian theories and the classical theories. They should agree on a long run prices and wages, adjust to the equilibrium level as the case might be. This is what we is the requirement of the day. The basic model is to either utilize Keynesian methods or classical method. about flexibility of wages and prices in the short run. Remember, we are not looking at a longer time horizon. Everything can be managed on a short run basis, but not a long run basis, wherein we need to adjust wages, equilibrium, and tweak the economies in your favor. With this, I come to an end of this particular presentation. I hope everybody will have understood what is macroeconomics and how does it impact our daily life. Thank you for watching this video.